Hello and welcome to our video lesson on crop insurance. In this lesson, we will explore the basics of crop insurance, including what it is, how it works, and the benefits it provides to farmers. Crop insurance is an important tool for managing risk and protecting against unexpected losses in the agricultural sector. As a commercial farmer, you face a variety of risks, from weather events to pests and disease, that can impact your crop yields and revenue. Crop insurance can help you manage these risks and ensure the continued viability of your business. In this video, we'll provide an overview of the different types of crop insurance policies, the underwriting requirements for coverage, and the claims process for receiving compensation for losses. Farming as a career means that your life depends on the safety and well-being of your livestock or crops. Commercial farming has been practiced by other continents for years, and it is now taking root in the continent of Africa. Increased investments in commercial farming comes with many challenges and risks. It is these risks that insurance companies endeavor to alleviate from farmers. Whether you're a new or experienced commercial farmer, this video lesson will help you understand the basics of crop insurance and how it can benefit your operation. So, let's get started. What is crop insurance policy? Crop insurance is a type of insurance that provides financial compensation to farmers in the event of loss of the insured crops due to failure or damage caused by natural disasters such as hail, drought, and floods, pests, or other perils. Crops insurance can also be extended to cover commercial tree farms, fruit orchards, natural forests, and tree nurseries against the aforementioned perils. The specific coverage provided by crop insurance can vary depending on the policy and the insurer, but typically includes 1. Yield loss. This coverage compensates farmers for losses due to a decrease in the quantity or quality of the crop caused by a covered peril, such as drought, excessive rain, frost, hail, or disease. 2. Price loss. This coverage provides protection against a decrease in crop prices, which can be caused by factors such as market fluctuations, oversupply, or changes in trade policies. 3. Revenue loss. This coverage combines yield and price loss coverage to protect against a decline in overall revenue due to a covered peril. 4. Prevented planting. This coverage compensates farmers for the costs of preparing land for planting when they are unable to plant due to a covered peril, such as excessive rain or flooding. Overall, crop insurance is designed to provide financial stability to farmers and ensure the continued production of food and other agricultural products, even in the face of unpredictable and uncontrollable risks. Types of crop insurances. The most common types of crop insurances are multi-peril crop insurance and named-peril crop insurance. 1. Multi-peril crop insurance, MPCI. Multi-peril crop insurance, MPCI, is a type of crop insurance policy that provides coverage for multiple perils or risks that can impact crop production. Assorted natural calamities such as drought, uncontrollable pests and diseases, hailstone damage, flooding, fire, lightning, earthquake, explosion, frost, and windstorm. MPCI policies are typically offered by private insurance companies. However, the government, through relevant ministry, can also design a compensation for the affected farmers in cases where there is a widespread loss due to an act of God, such as earthquakes, landslides, or even terrorism activities. MPCI policies provide protection for farmers by guaranteeing a minimum level of revenue or yield, depending on the policy. If a farmer experiences a loss due to a covered peril, the policy will provide compensation to help cover the cost of replanting, lost revenue, or other expenses. To qualify for MPCI coverage, farmers must typically meet certain eligibility requirements, such as planting within specified planting dates, using approved crop practices, and reporting accurate crop yields. Premiums for MPCI policies are based on the level of coverage selected by the farmer, as well as the type of crop, location, and other factors. Features. In this, we cover all sorts of crops in a single strand of large or small farms. The claim payable is determined by a qualified expert who inspects and scientifically quantifies the magnitude of the loss. Benefits. Cover for all kinds of crops irrespective of the farm size, cover from any form of loss associated with nature, stability, improved financial management and comfort in knowing there is a safety net for unexpected loss and associated costs. 2. Named-Peril crop insurance, NPCI. Named-Peril crop insurance, NPCI, is a type of crop insurance policy that provides coverage for specific perils or risks that can impact crop production, such as hail, drought, or excessive rain. Unlike multi-peril crop insurance, MPCI, which provides coverage for a wide range of perils, NPCI policies only provide coverage for the specific perils named in the policy. To qualify for NPCI coverage, farmers must typically meet certain eligibility requirements, such as planting within specified planting dates, using approved crop practices, and reporting accurate crop yields. Premiums for NPCI policies are based on the level of coverage selected by the farmer, as well as the type of crop, location, and other factors. Underwriting requirements for crop insurance. Underwriting requirements for crop insurance are the criteria that insurance companies use to determine if a farmer is eligible for coverage and to calculate the premiums for that coverage. These requirements can vary depending on the type of crop insurance policy and the insurer, but generally include the following. 1. Eligible crops. Only certain crops are eligible for crop insurance coverage, and these crops may vary depending on the geographic location and climate of the farm. 2. Planting dates. Farmers must plant their crops within a specified period to be eligible for coverage. 3. Approved practices. Farmers must use approved crop practices, such as using certified seeds or following specific planting and harvesting procedures, to be eligible for coverage. 4. Accurate reporting. Farmers must report accurate crop yields and losses to the insurer and may be subject to audits to ensure the accuracy of their reporting. 5. Payment of premiums. Farmers must pay premiums for their coverage, which are calculated based on the level of coverage selected, the value of the crop, and other factors. 6. Compliance with government regulations. Crop insurance policies are often subsidized by the government, and farmers must comply with government regulations related to the program, such as conservation practices or restrictions on certain crops. Overall, underwriting requirements for crop insurance are designed to ensure that farmers are using best practices to maximize crop yields and minimize risk. By meeting these requirements, farmers can protect themselves against unexpected losses due to weather, pests, or other perils that could impact their crops. Claim procedures under crop insurance. The claims process for crop insurance is designed to provide compensation to farmers who have experienced crop losses due to covered perils or risks. The specific claims procedures can vary depending on the type of crop insurance policy and the insurer, but generally follow these steps. 1. Notify the insurer. Farmers must notify their crop insurance company as soon as possible after experiencing a loss or damage to their crops. This notification may need to be made within a specific period to be eligible for coverage. 2. File a claim. Farmers must file a formal claim with their insurer, providing documentation of the crop damage or loss, as well as any other required information such as acreage and crop yields. 3. Inspection. The insurance company will send an adjuster to inspect the damaged crops and verify the extent of the loss. The adjuster may also take photographs, review records, and interview the farmer to gather additional information. 4. Payment. If the loss is covered by the policy, the insurer will issue a payment to the farmer based on the level of coverage and the extent of the loss. 5. Dispute resolution. If the farmer disagrees with the adjuster's assessment of the loss, there may be a process for dispute resolution or appeal. It's important for farmers to understand the specific claims procedures and requirements for their crop insurance policy, as well as to keep accurate records of their crop yields and losses. By following the claims process and meeting all the requirements, farmers can ensure that they receive the maximum compensation possible for their losses. Benefits of crop insurance to farmers. Crop insurance provides a number of benefits to farmers, including 1. Protection against unexpected losses. Crop insurance protects farmers against unexpected losses due to weather, pests, and other perils that can impact crop yields and revenue. By providing a safety net for these losses, crop insurance can help farmers manage risk and ensure the continued production of crops. 2. Access to credit. Many lenders require farmers to have crop insurance before they can qualify for loans or other forms of credit. By providing assurance to lenders that they will be able to repay their loans even in the event of a crop loss, crop insurance can help farmers access the financing they need to grow their businesses. 3. Increased profitability. Crop insurance can help farmers maintain profitability even in the face of unexpected losses. By providing compensation for losses, crop insurance can help farmers cover the cost of replanting, lost revenue, or other expenses, allowing them to continue operating their businesses and maintaining their livelihoods. 4. Flexibility and customization. Crop insurance policies can be tailored to meet the specific needs and risks of individual farmers, allowing them to choose the level of coverage and types of perils that are most relevant to their operations. 5. Government subsidies. Many crop insurance policies are subsidized by the government, which can help make them more affordable for farmers. These subsidies can help reduce the cost of premiums and make crop insurance more accessible to smaller or less established farmers. Overall, crop insurance provides important benefits to farmers by helping them manage risk, maintain profitability, and access the financing they need to grow their businesses. By protecting against unexpected losses and providing a safety net for crop production, crop insurance is an important tool for ensuring the continued production of crops and the viability of the agricultural sector. We have come to the end of this lesson. Please let us have your comments in the comments section. We will be back with another lesson shortly.